Hey, what's up, everybody? It's Matthew Mickey, and in this series, I'm going to teach you how to use the bond markets to be able to identify what kind of liquidity is in the market and how to use it as a leading indicator on macroeconomics and what type of market we're in. So we know that money has to be cheap or expensive. And why is that? Because money flow happens through a credit cycle, right? And so we know that cheap money leads to more liquidity. And when there's more liquidity, government, companies, consumers can borrow more of it. And that leads to higher growth in the economy because the strong consumer is buying more. That leads to companies expanding their manufacturer, and that leads to higher equities valuations, right? Which leads to higher earnings. And all this leads to inflation rising, right? And inflation leads to rising rates. And then money becomes expensive, things cost more, the dollar gets you less, and then you get a weaker consumer who spends less. That leads to companies having to produce less, which leads to them having to shrink their balance sheets due to people spending less. Them shrinking their balance sheets leads to them laying off workers because they don't need workers, and that leads to slowing growth in the economy. And then we have a reset. That's the most basic way to think of the business cycle, right? Now we know that companies drive growth in this economy. And we can look at the 10-year Treasury note as a benchmark. We can see if we compare the 10-year Treasury notes to where we are in a macroeconomic standpoint, it will show us where the, valuations for equities should be and what we can expect out of the earnings cycle for each company that's reported on a quarterly basis. But before we get into how to do that, let's do a quick definition of what a bond is. A bond, when you buy a bond, you're pretty much acting as the lender, whether you're buying a corporation bond or a government bond. The maturity is the time that they're borrowing the money for. So when I say a 10-year Treasury note, that means people buying that will be paid back in 10 years. You're letting the government borrow money for 10 years, and they're going to pay you back at an interest rate. And so if you don't understand this concept, go watch my Why Everybody Should Pay Attention to the Yield Curve class, and I break it down even further on how you can see the Federal Reserve's intent on the economy using the interest rates of the bond market. But moving forward, now we know that the 10-year yield is a benchmark for most financial institutions out there. And based off of that, we can use a discounted factor to measure, the cost of money. Is it cheap or expensive? And we can do this by taking the present value of a cash flow and seeing the future cash flow value of it, right? So here's how we do it. The people who set the rates, the interest rates, use this formula right here to see whether the money is cheap or expensive, and then they base the interest rates off of that. And we know that, the 10-year yield is used to set other interest rates such as corporate bonds, swaps, mortgages, and fixed rates. So they take this formula right here to find what the risk-free rate of the 10-year yield is going to be, to understand the discount factor and know the present value of his cash flow. So if the discount factor is dropping, then the present value for the future cash flow will increase. If the discount factor rate is increasing, the present value will decrease for future cash flow, and this will let us see the value of these companies and what we can expect for their price earnings. don't get confused with price earnings. A lot of people tell you that's cheap versus expensive, but you can watch companies have the same price earnings go from zero to infinity back down to zero. We're going to talk about that more into the equity side of things, like what that means and how we get out of it. However, price earnings is the most widely used evaluation of equity prices, right? So the price of the asset divided by the EPS of the asset. So if we look at the 10-year yield, and if it's near zero, then assets will demand higher price earnings because they have higher valuations. And this is because there's more liquidity in the market. They're expected to expand more and produce more because of a stronger consumer. So look at this chart of the 10-year yield, which is the dotted purple line, the price of the S&P, which is the white line, and then the earnings expectation, which is the green line. As that 10-year yield goes down to zero, the expectations of their earnings increases, which also leads the prices to increase. And this represents 500 companies that this happened to. And this was the last business cycle starting in 2012. Why? Because the 10-year yield was at a discounted price and expected earnings to higher present values. So the risk-free rate is subjective, yet fundamentally drives liquidity and equity valuations. And when you use that discounted factor analysis, it shows you where in the interest rate cycle we are and tells us where the valuations for the assets we're trading should be. Now, the central banks look at this and they control this, right? And you have nominal rates and you have real rates. And they use these real rates to provide liquidity or take liquidity away based off of where inflation is. But then they also balance it with maybe we can be inflated a little bit longer to prolong the expansion part of this business cycle. Real GDP growth keeps equity markets higher in valuations. So let's talk about the difference between real rates and nominal interest rates, right? So real interest rates are just the nominal interest rates minus the CPI inflation rate. So for example, if the interest rate is 5% and then inflation is 5%, what do you got? You got zero. That's like saying I got a 5% pay raise this year, but inflation's at 5%. I mean, what does that really tell you? So the real interest rates of the 10-year minus the 2-year will tell us if money is cheap or expensive, right? And if money's cheap, people are going to borrow more. It's going to lead to more liquidity in the economy. It's going to lead to inflation rising and growth expanding, right? And we also know that equities will be less volatile. Now, if money's expensive, there's less borrowing, which leads to less liquidity, which leads to deflating inflation, which leads to deceleration in growth. And equities volatility will increase because of the less liquidity. So look at this chart of the 10-year yield versus with the VIX overlaid in it. The green line is the VIX, right? We can see in the last business cycle that, as that 10-year yield was low, the interest rates were low, that volatility was, constrained between the low 20s and the teens. And there's certain times that volatility popped, but for the most part, volatility was low, and that tells you a lot about what kind of trader you need to be in. And if you don't understand this, refer back to my volatility classes. They're the first part of this whole course. All right, moving on. So using interest rates, real interest rates, and the volatility, it shows us the Fed intentions, whether they want to grow the economy or whether they want to contract the economy and slow it down based off of inflation and other aspects, right? And the whole part of the macroeconomic course is to use, the companies to see where the growth is going and where inflation is going. But in this part of the course, we're using interest rates and volatility to see where the liquidity is, right? So as the interest rate drops, valuations go up and the price goes up. right? So now let's talk about real interest rates. Like we already talked, it shows us the cost of money. And now what can we do with that, right? So we know that real rates are leading indicators to the equity markets and allow us to forecast, define the direction and the volatility, which leads to us knowing what type of traders we should be. Should we be looking for short-term opportunities, or should we be portfolio managers? Now let's look at the yield curve analysis, right? The price of a bond is inversely correlated to the yield, right? So if there's a demand for bonds increase and the yield falls. If there's supply, meaning there's more sellers than buyers, then the bond will decrease and the yield will rise. So now we're going to use a yield curve plot of all the interest rates of bonds of different time periods, like the Fed fund, the 1 month, the 3 month, the 6 month, the 1 year, the 5 year, the 10 year, the 20 year, and the 30 year, plus with the tips, which include the interest rates with inflation of the 5, 7, 10, 20, and 30 year, to see what type of market we are in. So I built this on Excel, and I put all of the bond prices as a data point, and that way I can slide from one date to another and see the yield curve, right? And to see where it's at. Now, we know that there's 3 ways this can go. The short-term rates, like the Fed fund and the 1 month and all the way to the 2 year, can be down, and the long terms can be up, which is a steepening curve, which is normal, which means, like, think of it from the lending department. Like, if I'm letting you borrow money, I'm going to pay you, if you're borrowing it for 1 month, I'm going to pay you less than what I'd pay somebody that's borrowing it for 30 years. So this tells us a lot about bonds being borrowed from the U.S. Treasury, right? And remember, yields going up versus yields going down leads to who's borrowing what, which leads to what investors think of going on in the economy, right? So in this case, we can see that we took 27 December, the short terms were flat and the long terms were, like, the 20 year was elevated. And we can see the same thing for 5 June as well. This is what a normal economic cycle looks like. Like, this means the economy should be expanding, valuations should be higher, and like, this suggests that investors are selling long-term bonds with higher interest rates to buy short-term assets and rates, right? Why? Because buying short-term rates or assets allows you to project that we are in a healthy economy and it's expanding. Why would I buy long-term and tie up my money with little returns when I can buy risk assets like equities or short-term rates and benefit from the liquidity that comes with that? So I'm going to sell my long-term rates to open up capital for economic growth, and when the economic growth comes to an end, I'm going to buy back those long-term bonds. And plus, at that point, as you'll see in the next couple slides, the long-term bonds will be cheaper due to inflation. Okay, so now let's move on to what a flat inverted yield curve looks like. So if we see that short-term rates like the 2 year have a higher interest rate than the 10 year, then we know that investors have lost confidence in the economic conditions and they're going risk off. They're going risk off by selling their short-term assets and their short-term bonds. They're going to cash positions and they're buying long-term bonds to weather the storm for the upcoming economy that they're projecting. Now, they know they're going to receive lower yields by buying these long-term bonds, but they're okay with that because they know something's coming. And this is how they mitigate their risk, because they know the economic condition will lead to slower growth, which leads to deterioration in materials, which leads to a weaker consumer and risk assets like equities, and that leads to bad earnings. So we live in a dynamic world. It doesn't happen overnight. We have to pay attention to the yield curve and where it's at, because it's going to tell us that size traders are transitioning from cyclical to defensive positions or vice versa. And how can we tell this transition is happening? Well, we can look at this right here, a flattened yield curve. So a flattened yield curve shows us indecision about what type of economy we're in. It doesn't show strength or weakness, but we have to take other indicators to figure out what type of economy are we in right now. Is the economy expanding, and has it been expanding for a while, or has it been contracting and growth has been slowing for a while? And this would tell us like where investors are transitioning their liquidity into. Like, are they like defensive and they're going into cyclical plays, or vice versa, right? And that's due to, let's talk about volatility and how that plays into place, right? So more expensive means more volatile. So we can always like look at the volatility and has it been elevated and increased in the market that we're in. So if we see a flat yield curve, maybe the Federal Reserve sees this as well too, and they're going to take measures such as quantitative easing, where they buy short-term bonds in an open market, and that will push for economic expansion. Now, the Fed is not stupid. The Fed sees it and will like base its agenda off of that. And the worst thing you can do is think that the stock market is the economy, because the stock market is not the economy. So don't turn bearish or don't turn bullish when you see a flat yield curve. You have to go to your other leading indicators and tie it all together, because there's no rule book in this market on what you should and shouldn't do, right? We just know that indicators show us the economic conditions and where we are. If I'm letting people borrow money and the yield curve's flat, that's saying I don't care how long you hold the time, you all get the same interest rates. So let's talk about what we've covered in this video. We know that benchmark bonds work as a system of measuring the value of money, which leads to us being able to project what equities are going to do. The value, cost of money in the markets, we can find through yield curve and real interest rates, right? They represent a leading indicator that tends to move before the economy does. So if the economy is going to grow, we can see that the economy is going to grow because the Federal Reserve will push liquidity into the market, which allows banks to loan more credit. And this all helps us predict the GDP, earnings, and asset side. So we're going to look at the liquidity in the bond market to see what kind of economic cycle we're in. And we're using interest rates to do that. Then we're going to use the macroeconomic effects. And knowing all this will prevent us from being the wrong type of trader. So real interest rates represent inflation-adjusted cost of money, right? And the yield curve represents the market expectations of short-term versus long-term risk in the economy. And therefore, risk assets like the S&P 500 can be used to benefit from future moves. There's no rule book. This is why I've taught you guys the VIX and volatility, and now the bond market to give you a leading indicator. There's no rule book in this market. You have to understand that, but you do use these leading indicators. And as you can see on the slide of what I'm going to teach, to understand where you should be at. All right, later.